and welcome to Your Money, Your Call. I'm Jeremy Hook from TMS Capital. Tonight, as always, we're here to answer your questions about shares or stocks or anything in the share market. So our phone lines are open. The number to call is 1300 30 34 35, or you can email us on yourmoney@skynews.com.au. Any other forms of getting through to us are valued, Twitter or otherwise, but the questions are valued. So please get some good calls through to us tonight. We're looking forward to it. On the panel tonight, we've got David Novak from Wealthwise Education and David Buckland from the Montgomery Fund. Welcome to the program. Well, it's certainly been a very robust start to the year. It's my first appearance on the show, and certainly good to be on when the market is high, but the questions that come from it are equally as challenging, and not everybody does, of course, get the benefit of the market rally. So, David Buckland, welcome to the show, and
thanks, Jeremy.
Welcome to reporting season. And David, is there a lot of value around, or do we need something special from reporting season to sort of prove it up?
I think value is difficult to find on a sustainable basis. I think what we've got here is really a yield-driven sort of bull market. What's effectively occurred is cash rates now are starting to really get very low. Obviously not as low as Europe, UK, Japan, America, but they're starting to get very low. And as Roger often makes the comment, if you retire with $1 million, you used to think you were rich, but now you're earning less than $30,000 in fixed interest on that $1 million. And so it's forcing my parents' generation to stop earning the $30,000 on the million and actually starting to make part of it work.
Yeah.
And as interest rates keep declining, they're forced, in a funny, odd way, to actually take more risk. And this is exactly what's occurred over the recent weeks.
Yeah, so David Novak, have you enjoyed the rally?
I don't know if I've enjoyed it. I've been just quite shocked by it.
Yeah.
You know, it's 11 days up, 500 points straight. Is been something I can't remember ever seeing before. All driven by the financials, and as David was saying, the chase for yield.
Yes.
You know, but geez, they've this has certainly been dominated by the banks. And if you look at the makeup of our market, nearly 30% are the bank stocks, and then you've got nearly half of the financials.
Yeah.
So that's what's dominating this space right now. We've seen a little bit of a recovery in resources.
Well, that probably helped the index, didn't it, overall? And but they're still not off the carpet, are they? A lot of those resource stocks.
No, well, that's right.
Yeah.
But certainly the banks have been dominating this rally, and for how long it'll go, I don't know. But there's certainly risks out there, that's for sure. Yeah,
that's great. We might just get straight into an email, because I think speaking about the general market has got some value. We'll talk more about that later. But if we go to Enrique has sent us an email. He said, "Hi guys, I would like to get your opinions on Sydney Airport and Transurban. Do you think they're a good buy right now?" Now, that's, I think, a really good email, because it speaks to both of the answers you guys have given me tonight there to start the show. Both, I think, at a time were excellent, solid infrastructure stocks that paid high yields. They've gone up a lot. When price goes up, yield goes down. David Buckland, would you buy either of those now?
Well, you're exactly right, Jeremy. What has occurred in both cases is it's a highly reliable infrastructure assets. The people at both companies pretty much can predict their revenue lines extremely closely, and there's obviously a certain amount of growth. We see the prices of either toll roads or every time you go to Sydney Airport just go up by that 3, 4, 5, 6% every year without fail. So it's always got a bit of growth, and they're lumbered with a lot of debt.
Yes.
These businesses. But very, very reliable earning stream, lumbered with a lot of debt. So what happens is, as interest rates keep being compressed, the valuations for these stocks do go up. But, at the end of the day, in traditional terms, they're on P's of 40 times or 50 times or what have you. But they are paying out of their cash flow dividend yields of maybe 4.5% or 5.5%. So once again, it's really a yield play, and it's a compression of interest rate play. And one day, not today or tomorrow, but one day when interest rates reverse, these are exactly the sort of stocks that will get hit hard because they've enjoyed this compression of interest rates so enormously.
Yeah, no, excellent. David Novak, do you like either of those?
I don't really. You know, I concur with everything that David said there. If you just look at Sydney airports, for example, you know, I mean, today, it's on a yield unfranked of 4.5%.
Yes.
You know, the market valuation up here is just over 11 billion. Their profit is just around 140 million. So you'd look at the earnings multiple, unfranked yield, their average earnings growth has actually been negative for the last 2 years. And yet the stock price has risen, like from, you know, 2011 here, looking at a price of, well, even 2009, about $1.40 to a closing price of $5.15.
Yeah, that's right. Yeah.
The earnings aren't there, you know. It's I wouldn't be a buyer of the stock, but
No.
again, it's a bubble in valuations that we're seeing up here because of such low interest rates.
Yeah, that's it. And they've only recently both gone ex-dividend, so there's no benefit, there's nothing odd about it. It's just a real yield push. But I would say this, they're both basically sound assets that underlie it. It's just you've got to pay the right price for any asset that you buy. And really, I think we'd all agree that this is not the right price. So, again, it might look right from now ongoing if we see further reductions in cash rates. But the risks are high when you pay prices in the order of this for now. Better off something with a real earnings growth story, because that'll catch up any underperformance that follows from a pullback that we might see at some stage. So thanks for your email on Rick. We've got a caller from Sydney. It is Luke. Good evening, Luke.
Hello, how are you going?
Very well, thanks. How are you?
Good, thanks. I'm calling about my netphone. It's a MNF is the code.
Okay.
It's a small telecommunications company. The earnings are projected to double over the next 3 or 4 years, but the share price has been really volatile lately. Just wondering what you guys think about the company.
Okay, terrific. Thanks very much for your call. And we might start with David Novak on my net phone.
Yeah, look, the earnings have been quite strong. Certainly, average earnings growth of about 26%. You know, it's not a yield play, because if you look at the yield, it's 1.6%. It is fully franked. But the earnings growth has been there, but it's trading on a very high multiple, like many stocks, 30 times. It is fully valued at this price level, and that's why the stock pulled back. When we look at the chart in November last year, that was the peak. It was about just above $3.94, pulled back to $2.70 here. It is in a downtrend, so just based on the trend and the valuation metrics, it's not a buy right now.
Okay, yeah, no, thanks for that. Good return on equity, David Buckland, but is earnings certainty or uncertainty a bit of an issue for a company like this?
Yes, that's right. So there are several, I'll call them second-line telecommunications companies that have developed superb niches where I'll call it the predictability of earnings is quite high. And so what actually happens is there's a number of them. So M2 Telecommunications has been a classic, both through acquisition and organic growth. They've been able to grow their earnings very, very, very solidly over about a 10-year period. Now, I don't know enough about MyNet Phone, but the idea clearly is when you're analysing these sorts of stocks is be able to understand their earnings drivers, what niche they have, and do they have a high level of predictability of earnings to the degree that you could sort of say, with your hand on your heart, the earnings could be much greater in 2 or 3 years' time than they are today. And if that's the case, there's a high probability the share price will do well.
Yeah.
But as I say, I don't know enough about this one, but I'd suggest that the caller understands those earnings drivers, and if he's confident, then it'll probably do okay over the longer term.
Yeah, okay. Well, thanks very much for that, guys. Our next caller's on the line. We've got Shane there. Shane, good evening.
Hello, boys. Thanks very much for giving your time.
Thank you.
I just wanted to ask about Tabcorp, when it might come back online, and when you've got to buy it for to get that extra dividend.
Yes, okay. Very good question, because Tabcorp reported today. It was one of the first out of the blocks in reporting season. David Buckland, did you get your eyes across the Tabcorp result, or is it?
We actually had a very good look at Flexi Group, which we own,
yes,
and realestate.com, which we do not own.
Yes,
just a bit expensive for us. But Tabcorp, we haven't owned it simply because for us it's just too expensive versus our valuation. I mean, clearly it's. I would say it's a business that generally has relative reasonable predictability of earnings, but for us, its return on equity is a bit low. It's like a 10 or 11% return on equity type business. We're shooting for businesses that maybe have 20% ROEs or higher and high incremental return on new capital. So it's one that really hasn't sort of got onto our radar screen from a price point of view.
Yeah, no, I didn't look at the result. I mean, this is a stock I haven't really been in for quite a long time, but I know today that part of the announcement was involving a large distribution of the franking balance that they have,
yes,
and a capital raising, which is quite similar to the deal that Harvey Norman put to the market last year. Quite novel, but one way of getting franking credits in the hands of shareholders who can use them, yes, an asset that really isn't a whole lot of use to the company. But we don't. Do you know the answer to the question about the ex-date on that one, David Novak?
I don't. I do know they announced the special div, and a capital raising as well.
Yes, that's right.
I think it's about 236 million. It was a good half-yearly result.
Yeah.
But again, on valuation,
yeah, you can't.
I can't touch it. And I've got on the chart here, I've got what I call a turning point indicator here, and it's telling me from the RSI and everything else that this could pull back quite sharply from here after it goes ex-dividend. I don't know when the ex-dividend date is.
No. I would assume we're probably a week or so away from a dividend, or maybe a couple, and that may coincide, Shane, with the ex-date for that capital as well. But all of that tied up, and with valuations we're not really comfortable with, I think probably you want to be looking elsewhere in the market at the moment. And certainly that's what we're doing. And today in the reporting season, like David Buckland, I was looking elsewhere, and I didn't get across Tabcorp because, quite honestly, we can't make the numbers add up either. But it has performed well. It's not the first good result. It's about the second or the third for them, but they've been in the doldrums previously for quite some years. So I think Tabcorp probably best on valuation grounds to be avoiding. We're going to go to a break now, but we'll be back after that break for more of your calls. The number to call us on is 1300 30 34 35. We'll see you very shortly.
I was managing a powder coating plant, but there was just something inside me that wanted to do something more worthwhile. When I first met her, I thought she was a bit of a cheeky brat. That was 10 years ago.
Ken means everything, because without Ken, I won't be able to play bocce.
For their full story and rewarding careers, visit Care Careers.
How do you outperform the stock market on a consistent basis? Obsessed with this idea, Michael Kadari forms COSEC, Kadari Securities. He seeks, in his own words, a revolutionary investment strategy based on better information and knowledge, not tradition. Wealth begins with better knowledge becomes his motto. He seeks to identify and accurately pick the next top-performing stocks on the ASX. He seeks for consistency. Michael Kadari creates a unique stock market filtering system he names Lotus Blue, after a flower that blooms just once, because in investing, timing is everything. Now, COSEC's buy picks are so accurate, he introduces 3 of his top-performing stocks on national television. As these stocks surge, so does COSEC's success rate. If you want the COSEC investment edge, you know what you have to do. Call COSEC now and take advantage of the insights he reserves for his clients with your free COSEC stock report, or visit cosec.com.au.
Grass stains? No worries. I love watching my son play cricket. The cricket means grass stains. Regular detergent alone isn't enough, so I soak it in Crystal White before washing. How's that?
Try Vanish Crystal White for 3 shades whiter whites. This cricket season, celebrate your whites and buy Vanish for your chance to win a private net session with Mark Waugh. Only at Coles.
Good day. Welcome to Hello. Unlimited broadband, no lock-in contracts from $48 a month. That's unlimited broadband, no lock-in contracts from $48 a month. Call us or visit hello.com.au. Terms and conditions apply.
Christine and Adrian, real everyday Apia customers. Do you think it's odd that when Christine called Apia, she got to talk to a real person and not a machine? Odd? It's not odd at all. Good service means taking the time for a chat 24/7 and not rushing you off the phone. Because the oddest things can happen at the oddest times. If you're over 50, call Apia for a chat today and find out how they reward your experience.
What a mess you blokes are in. You and your mate are toast. You know that, don't you? Toast. I actually believe he's in considerable trouble. He may survive Tuesday.
He'll survive Tuesday.
But he won't survive much longer. They are coming to get him.
The only loser will be the Liberal Party.
Welcome back to the shares edition of Your Money, Your Call. We're still taking your calls on 1300 30 34 35 or via email yourmoney@skynews.com.au. I'm joined tonight by two Davids, David Novak from Wealthwise Education and David Buckland from the Montgomery Fund. Our caller on the line now is Peter from Melbourne. Good evening, Peter.
Good evening, guys. Just like to get the panel's view on two stocks being Ansell and REA Group.
Okay, yep, terrific. Ansell and REA. Thanks for your call, Peter. And two good stocks, certainly one that was in the news today. I was on the teleconference line and was very impressed by REA. David Buckland, you were
equally impressed.
Yeah.
The issue for us, Peter, unfortunately, is it's a brilliant stock. It's just a bit too hot for us, share price-wise. But it ticks all the boxes. It's got a brilliant balance sheet. It's got massive return on equity. It's got massive return on incremental equity. It ticks all the boxes. It's just the missing jigsaw part of the jigsaw puzzle for us is price.
Do you have that as a price objective where it would be interesting for you, David?
Yeah, I would say possibly about 10% cheaper.
Yeah, okay.
We'll be sort of having a serious look at it.
So maybe $45 or something.
Correct.
And of course, I guess the thing to say is admiring quality in a business, but paying a bit too much is often less of an evil than doing the other, finding a business which is out of sorts and might look cheap, but it doesn't ultimately deliver.
Very, very good businesses. Yeah. The share price will be looked after over the medium to longer term.
Yeah.
And we've seen that with those 5 or 6, I'll call them superb stocks in Australia, of which obviously CSL is one, REA is another, SEEK's been another more recently, but there's probably 5 or 6 in Australia, where, of course, at the time you look at it and you go, gee, Ramsay's another one.
Yes.
I've paid a bit too much, but, you look back 5 years later and you go, yeah, I probably paid too much, but the quality of the business looks after you over time.
Yeah, no, great. David Novak, is REA too hot for you?
Sure is. I sound like a broken record.
That's all right, that's okay.
Same thing, exactly what David's saying. The valuation is very stretched. They're in great business. But look at the run-up here, from $42 in mid-December to just over 51.
Yeah.
Great run, but it is stretched on... Plus, it's not a yield stock.
You don't get much of a yield there, no.
So it's just a growth story, but you're paying very high multiple, about 40 plus times. So
yeah. Okay, what about Ansell, a change of business altogether? This is obviously a very good business. Had a rock up and down sort of 2014, didn't it? Is that one that comes on the radar in any way for you?
Not really. It's again. It's not a yield play, it's unfranked 2%.
Yes.
Look, it's a steady business. It's a stable business, stable earnings in that sense, so it's reliable. But again, from a valuation point of view, 21 times earnings multiple, it's not a growth stock.
No.
If I look at the chart here and you see the trend, it's getting some major resistance up here. In fact, if it fails where it is right now, this will be what they call in charting terms a double top pattern.
Okay.
That'll only be confirmed if it breaks below 2160. That'll be a very bearish pattern for the chart itself, and if it follows this pattern of being a double top. But I couldn't touch it up here.
Okay.
Yeah.
David Buckland, Ansell, I would regard as a quality business.
Yes.
I'm not sure I'm comfortable with the price. It's reporting February 16, I think. What do you think?
Well, I would agree with that, Jeremy. We haven't owned it. It's always been on our sort of short list without owning it. The return on equity is probably sub 14%,
Yes.
probably not sort of sexy enough for us in a way. So it's there or
No
thereabouts.
pun intended. No.
Yeah, that's right. It's there or thereabouts, but just hasn't quite made the grade. In terms of quality's probably nearly there, but probably just has never been quite cheap enough for us.
Yeah, no, same. I can't buy it. I do hold some REA, but ever so few compared to what you'd like. And again, I have a great admiration for REA, but I'm with David Buckland. 10% lower starts to make a lot more sense, and it does move around. It certainly had weakness through 2014, and if it does, I do think they're the sorts of stocks you want to buy, particularly when the market's having a bit of a breather as well. So thanks for your call, Peter. Our next caller's on the line. We have got David calling from Melbourne as well. Good evening.
Oh, good evening. Thanks for taking my call. I'm sorry, another David to confuse you.
That's quite all right.
I wonder if I could ask you gentlemen a question. I have ANZ shares and Commonwealth Bank shares, and late last year, there was the Pearl 7 offer on CBA, which I didn't take up. There was a low yield, 2.8% margin, I think, and then the price, I think the price now is 95.8. So it went down a lot. But I've received now ANZ Capital Notes 3 offer, where they're giving a margin of 3.6%. And I was just wondering if I could ask these gentlemen if either of them are good going into the market and buying the Pearl 7 at a discounted price, or the Capital Notes ANZ 3 with a 3.6% margin. If they've got any ideas, and is it and also is it the time to sell bank shares now? And if so, where would you put the money?
Excellent, David. A curly one for our Davids. Thank you for your call.
Thank you very much.
Okay,
I'll hang
that's
up and
great.
listen. Thank you very much.
Terrific. Yeah. Now we'll get to both of those. The first part of that was about the interest rate securities, the capital notes, which of course are quite a large part of the market. Banks tend to issue a lot of them. They're cheap funding for banks, and it got to a pretty heavy stage with that CommBank Pearls offer at the end of last year, which was probably the least attractive offer that we've seen from any of the banks issuing those. The ANZ is marginally more favourable, but again, there are some caveats with this space. Guys, any comments about capital notes, hybrid securities of this kind, generally speaking?
Yes, I think Chris Joy from the Australian Financial Review has written about these instruments extensively, and there's 2 or 3 points to make. The first point is they are cheap capital for the banks. They're regarded as tier 1. I'm not sure if they're a great buy for the investor, and the reason I say that is because you've got to read the fine print very, very closely. In one case, there is absolutely a discretion on whether that yield is paid. Now, it's not contractually a contractual obligation like a coupon on a bond. It's at the discretion. And if we had another GFC, I can absolutely guarantee the discretion would be, hey, we're not paying this year. Now, what happens to the price of that instrument if the management woke up one day and said, we're not paying that coupon this year or this half year? It would get smashed. And that's one of the reasons when they list, they don't often list at a premium, they often list at a discount. So you've got to be very aware, and as I said, Chris Joy from the Fin Review has written extensively about these. I think sometimes it's better to just buy the underlying instrument, for example ANZ, and take the yield rather than necessarily buy the hybrid. So that's something to very much consider. I think chasing yield, you've really got to weigh up the risk of that yield, David, and that you've really got to read the fine print with these instruments. The final point, are banks cheap? No, of course they're not cheap. If you look at banks anywhere in the world, our banks in terms of their 2.5 times NTA are definitely expensive. But what happens is we have this thing called the superannuation guarantee levy. It's $2 trillion. It's forecast to go to $7 trillion in the next 20 years. And people who have a lot of super have to try and get a return on that super, so they invest domestically, particularly for fully franked dividends, and so they invest in this very, very thin market, and they chase things with yield. And the banks, because of that monopolistic connotation or that nice cartel, they've done particularly well. They really did avoid the GFC in a fairly significant way, unlike most banks in America, Canada, Europe and the UK. They did very well in the scheme of things. They still needed the federal government to step in and back them. But at the end of the day, they are not cheap instruments.
Yeah, no.
They are there primarily because interest rates are at record lows.
Right, thanks, David. David Novak, I might focus on that back part. Are banks expensive?
Yes, absolutely.
Okay. So would you sell them?
Well, particularly CBA over ANZ. You know, CBA's yield has come down to nearly 4%, compared to ANZ's is just a little over 5%. Plus on the earnings multiple, you're comparing like 13 to 17 times or nearly 18 for CBA, which is the highest historical earnings multiple ever. You know, the valuation is just unbelievable. But again, today I think there was a short squeeze because...
had that look about it, didn't it?
Yeah, it certainly did. Because a lot of people who sell call options were probably buying back those options in fear of getting exercised before the div. So I'd say to the caller, I'd certainly be a seller of CBA or selling. You could do a call option strategy and sell call options slightly out of the money. The premium is fantastic right now, and actually use that premium to buy the protection. And so you keep the shares and keep the dividend. And if you get called away, so what?
Interesting option strategy. Thanks for that, David. And we're going to go to a quick break now. If you'd like to give us a call, please do. Our experts are here for your calls. 1300 30 34 35 or yourmoney@skynews.com.au.
Christine and Adrian, real everyday APIA customers. Do you think it's odd that when Christine called APIA, she got to talk to a real person and not a machine? Odd? It's not odd at all. Good service means taking the time for a chat 24/7 and not rushing you off the phone. Because the oddest things can happen at the oddest times. If you're over 50, call APIA for a chat today and find out how they reward your experience.
Hey! What I like about you, you hold me tight. Tell me I'm the only one, wanna come over tonight. Yeah, keep on whispering in my ear. Tell me all the things that I wanna hear, 'cause it's true. That's what I like about you. That's what I like about you.
As soon as I get up, I'm on my feet, sourcing Australia's freshest ingredients. Then I'm in the kitchen, cooking for my toughest judges. But no matter how long my day is, my feet get all-day comfort thanks to Scholl.
Scholl Advanced Gel Active Insole technology offers shock absorption, arch support and superior impact cushioning to help reduce excessive pressure under the foot.
With my feet in check, I'm free to focus on what's important.
Enjoy all-day comfort with Scholl insoles. Scholl, stand up for your feet. Experience a new world of clean with the wide range from PinoClean. Our most powerful cleaners give you an unbeatable shine you can see. And a lasting fresh fragrance you can smell. Bring your home to life with the PinoClean range. It's not clean unless it's PinoClean.
How do you outperform the stock market on a consistent basis? Obsessed with this idea, Michael Kadari forms COSEC, Kadari Securities. He seeks, in his own words, a revolutionary investment strategy based on better information and knowledge, not tradition. Wealth begins with better knowledge, becomes his motto. He seeks to identify and accurately pick the next top-performing stocks on the ASX. He seeks for consistency. Michael Kadari creates a unique stock market filtering system he names Lotus Blue after a flower that blooms just once, because in investing, timing is everything. Now, COSEC's buy picks are so accurate, he introduces 3 of his top-performing stocks on national television. As these stocks surge, so does COSEC's success rate. If you want the COSEC investment edge, you know what you have to do. Call COSEC now and take advantage of the insights he reserves for his clients with your free COSEC stock report, or visit cosec.com.au.
I want some of you to try to make all of us laugh. So if you're a comedian or a would-be comic, then send me a 2-minute routine, a stand-up or a skit, and see how you go. You might get a thumbs up, you might get a thumbs down. But Make me laugh. Hinch Live, Sky News.
Welcome back to the program. Joining me on the panel tonight is David Novak from Wealthwise Education and David Buckland from the Montgomery Fund. If you've got a question for us, please give us a call, 1300 30 34 35, or via email yourmoney@skynews.com.au. Our next caller's on the line. It's Michael from Sydney. Good evening, Michael.
Hi, thanks for taking my call.
You're welcome.
I've just got a two-part question. Our first question is on Cedarwood, CWP.
Yes.
The property development at Western Australia. With the low interest rates, it's got good tailwinds, it's got a really good balance sheet.
Mhm.
They've just had approval for the Upper Kendron in Brisbane.
Yes.
And also Western Australia and I think Queensland, which they're mostly developing, has got good population growth. I was just wondering whether to buy back. I already own the stock, but I got it probably a bit below this price. Was it worth buying more into at this price? And also there's a bit of a competitor, well not so much a competitor, of Finbar,
yes,
which is also a Western Australian company as well. Mate Trentino just wants to know, is that a good time to buy because it's been on a dip?
Yeah, sure. Great. Thanks for your call, Michael. We'll have a look at the two WA property groups, Cedarwood and Finbar. There's a yield there. There's a bit of excitement. There's a bit of volatility, though, David Buckland.
That's the problem, Michael, is the volatility in terms of the predictability of earnings of these companies is low, in that they can go for long periods where they make quite excellent numbers, and then they can go for long periods where they can make very poor numbers. And for example, if a large project falls into the ensuing financial year, the year just gone by might be hit quite hard with the numbers. But that said, both companies, as you say, Michael, probably have quite a good tailwind. I should also point out, though, that the household debt to disposable income in this country has been running, at very, very high levels now for about 5 or 6 years. So it's really been the investor market to some degree that's got this space going. But the average householder still has a lot of indebtedness and has had so for about 6 or 7 years. So from one side of the coin, it doesn't look like an easy space to be in, but on the other side of the coin, with the investor market wanting to chase these sorts of assets, it does look like it's got a good tailwind. But in both cases, our valuation is neatly higher than the share price. In both cases, the return on equity generally is quite high. In both cases, the balance sheets are reasonably solid. And in both cases, they don't look overly expensive. So I think it's one that it would certainly be due for some additional homework.
Okay, excellent. Yeah, thanks for that, David. David Novak, are these of any interest?
Look, on the chart, looking at the chart, Cedarwood definitely looks better from a structural point of view than Finbar. It's been consolidating, as you can see there. I mean, if anybody bought the shares at $6 here, you'd put a stop under that previous low at $5.50. Look, they're paying good dividend yields, both companies. The difference, Finbar or Cedarwoods is slightly a bigger company with a market cap of 460 million versus Finbar, which is about 260, I think. But look, they're good dividend yields. They're not overly expensive. My biggest concern is they're both leveraged to the Western Australian market,
which is volatile.
Which is very volatile, and you've seen resources come off the boil. Lots of layoffs. You've seen soft property prices over there. And plus the state government has blown a hole in its budget because it's not going to get the royalty income they budgeted for. So look, I'm very cautious about that market. And these two companies obviously are highly leveraged there. So, but again, if you buy, if I had to choose one or the other, I'd take Cedarwood just because of the chart pattern, and I'd have a close stop below. And again, the number of shares that are issued is only 78 million shares on issue with Cedarwood versus 226 million with the other one. So any buying interest can push Cedarwood's share price much faster, quicker up than the other one. But again, it's very thinly traded, and there's average monthly, daily volume of something like 22,000 shares.
David's got a very good point there, Jeremy, and that is that this Western Australian economy, we had iron ore prices at $100 to $180 a tonne for some years, and now it's in the low 60s. And we had oil prices at above $100 a barrel for a few years, and now it's sort of in the 40s or 50s. And there's a lot of projects that had this sort of superb multiplier effect into the broader economy, the companies that service those two sectors, the oil and gas sector and the iron ore sector. And now it's battened down the hatches from those sectors. And so there's a lot of companies that were servicing those sectors that are going to see a really, really, really tough period. And they're going to be laying off. Everyone's battening down the hatches, and one has to be aware of that, particularly if these companies end up with a lot of stock and they're trying to sell that stock. There may be pressure on that stock.
Yeah, they're great comments, and I think where it comes to a valuation perspective for Michael is that you can't really compare these kinds of property investments to those in more stable earnings bases on the East Coast, and you do need to get cheaper multiples and better yields when you're buying either of those kinds of stocks. So they're not going to compress to quite the level of the office trusts and the like, which are based in Sydney and Melbourne. That's just how it is. Thanks for your call, Michael. Our next caller's on the line, and we have Abe from Sydney. Good evening to you, Abe.
Oh, thank you very much for taking my call. I'd like to ask the panel medium-term outlook on Crown Casino and Sigma Pharmaceutical, please.
Okay, Crown and Sigma, thanks for your call, Abe. Crown certainly of interest. I do like Crown. Sigma's not one I've looked at. David Buckland, either of those of interest to you?
Crown is a better business, but just too expensive for us. Okay. Has a lot of good attributes. Its indebtedness is not over the top. It's got a reasonable return on equity. It's got a reasonable return on incremental equity, but it's just been too expensive for us, Jeremy.
And obviously the chart's on screen now. It's come down a fair way, notwithstanding the bounce over the last week, but certainly the back end of last year was pretty unkind to it. So you're needing it further into the $10 or $12 level?
That's correct, yes. So what actually happened last year was we did see, particularly with the austerity program in China, Macau got beaten up left, right and centre. And we saw table revenues in Macau year on year down numbers like 25 to 30 percentage points. Okay. And so to think that this is a space that's stable, it is not stable.
No, there's many factors there. But there is geographical diversification in the business that's growing. Obviously Sri Lanka, Sydney, these are some upside potentials for it. But, I tend to like it. Reporting on February 20, David Novak, any interest in Crown?
Look, it's had a good run up here. It's, I agree with the comments that David made there. Like I said, if I look at the share price here, right at the note we were just looking at it a moment ago, it's come up to what they call a resistance level. Mm-hmm. So it needs to consolidate here and break through that level, which is around $14.50. On valuation, it is stretched. I mean, the yield is around 2.5%, 50% franked. So again, it's not particularly a yield story. It's more the growth story, and as you said about Macau. But look, on valuation, brokers have a valuation of the stock between 15.50 and even up as high as 17. So it's quite wide. So it's trading at 14 at the moment. But, look, it doesn't attract me right now.
Okay, what about Sigma, which was Abe's other question? Is that one that you like the look of, Sigma?
No, I don't like their earnings have not been, a standout. It's their average earnings growth for last year was pretty poor, about 8% down actually. 11% growth over the last 2 years. Again, it's only paying a yield of 2.5%, but it is fully franked. But the earnings growth is not there that I can see at the moment. And on the chart, it's hitting a lot of resistance up here as well. From the charting from the previous peak that it reached just recently, so it's pulled back very sharply. So again, it looks fully valued to me.
Okay.
There's no earnings growth story there.
Right. Is that how you see it, David Buckland?
Well, I would say the word pharmaceutical is a bit of a misnomer for this one because it's very much a commodity player. Most pharmaceutical companies have enormous returns on equity, 30, 40, 50 percentage points. This one has
9 or something?
7, I think it is, or thereabouts. So it just, we would just say it just isn't the quality that we're looking for.
It's more a distribution company, isn't it?
It's a distributor.
Yeah.
But even despite that, our valuation is closer to 50 cents.
Yeah, okay. Well, okay, so Abe, we can't get any love for Sigma. Well, I don't think we mind Crown, but ideally both the panellists tonight would like to see the stock a bit lower before entering into Crown. We've got our next caller on the line, John from the ACT. Good evening, John.
Hi, I'd just like to know the panel's view on ThinkSmart and Matrix Composites and Engineering, if I could please.
Okay, thanks for your call, John. John's interested in TSM, which is ThinkSmart. Great name, but can we do that? That's the question. David Novak, TSM.
Yeah, look at just looking at the share price performance, it really hasn't gone anywhere in just over a year. And again, looking at I can see why their earnings have been terrible, down 36% average for the last 2 years.
Yeah.
So it's presently doesn't have a dividend yield. There is one forecast at the end of the year of around 2.8%, which is a 1 cent dividend. Yeah, look, I just can't see the attraction on this one, but was it Matrix?
Yeah, MCE is the code on Matrix.
Yeah, this one's interesting. I actually prefer this one, but there's no dividend. But they have got a fairly bullish forecast of earnings growth. They were making losses for the last 2 years, and they just turned it around end of last year. So it'd be interesting to see their interim report, whether they can turn around. And also on their chart, they've come down to a fairly low level down here, around 62 cents. A bit of buying volume came in just recently, actually, so there is some interest. But again, the trend is terrible here.
Yeah, it's a story of the sector, really. You could overlay just about any stock in that sector, you'd see a similar pattern, wouldn't you, really?
You'd wait for their half-yearly report.
Yeah.
And it's not just their half-yearly report, Jeremy, it's also their commentary. Because what's happened is that a lot of these businesses are only just starting to be hit in the last 6 months. And I think the commentary about the balance of the calendar 2015 year is really crucial to understand the prospects of these businesses. And I just basically take a view that unless the prospects are, very, very solid.
Which they're unlikely to be.
Which they're highly unlikely to be. You might have something that's in a very specialised niche in, for example, the infrastructure space, which might be backed by, say, a lot of government spending. But if it's more broadly in the mining services space, the oil and gas space, the iron ore space, then, I just think it's basically going to be tremendously difficult.
Yeah, no, I think pretty tough. Thanks for that, guys. This is a nice time for a lot of people in the market, but for those who've sat in term deposits and they're now maturing and they're seeing cash rates and all deposit investments fall, is it time to, when those mature, put a little bit in the market, or do you stay right out based on comments we've heard from both of you tonight? Can you afford to be out of this market? Is it going to provide better yield than cash, notwithstanding the fact that values aren't what they were? David Novak?
No, I personally think it's time to take some money off the table.
Yeah.
I think there's too many risks out there that aren't being factored into the market. That's clear because of central banks driving these, interest rates to zero, and now you're seeing bond yields coming down to ridiculous levels. Something's going to crack. It always does. You'll get some credit default somewhere, whether it's Greece or whether it's going to be the oil shale US producers who are underwater right now, and there's $500 billion in debt there. There has to be a shake-up in the bond market, and I think it'll be in corporate bonds or sovereign debt. That's the biggest risk, and investors don't realise that can come out of left field, like we saw in the GFC.
Yes.
And that's what we've got here. We've got a perfect scenario for a GFC-type situation.
So be patient if you're in that position, and opportunities, you've seen through your experience, David Buckland, your experience, will present. Is that how you see it, David?
I think opportunities always present. What happens is there's always something from left field that you least expect that'll come along and make the market or selective stocks within the market cheaper. And there's always going to be high-quality businesses that come to a price that's reasonable. And I think for people who have got money burning a hole in their pocket, earning only 3% or 2.9% now. They definitely have an opportunity to put some money in the market, but they've got to be selective and they've got to be discerning.
Yes.
I think that's very important. And I think just going and buying for the sake of buying is a bit of a mug's game.
Yeah.
I think also what has happened is that in a way the compression of interest rates are punishing people who've been really great savers.
Yes, it is.
So it's in a way it's sort of very, very
slightly unfair, yeah.
that these poor people now end up having, or these wealthier people now end up having to take greater risk because the market's rallied. But I do know one thing, and that is bear markets very rarely commence until the last person has sort of bought the stock. So we haven't gone through that phase yet where people have been, pushed into the market. I would suggest if we have one more interest rate cut, which I think is definitely on the cards if our domestic economy slows, and then what happens is you get this whole wave that might last 6 months, and then what happens is that once the last people are sort of bought, and then that's how bear markets tend to commence.
Yep. Price peaks and risks at the same time, and that's the thing that people do have to take care of. I think very good advice from both our Davids here tonight. We've got to go to a break, so we'll be back after that break on 1300 30 34 35 for more of your calls.
Good day. Welcome to Hello. Unlimited broadband, no lock-in contracts from $48 a month. That's unlimited broadband, no lock-in contracts from $48 a month. Call us or visit hello.com.au. Terms and conditions apply.
Let's go again. Don't do it.
If only everything was as easy as creating your website with Wix. Go to Wix.com today. It's free.
You ready for this? Bring it on, muchacho.
Prove who's the better driver once and for all with Amy's Safe Driver app. Challenge your friends and download it for free today.
Read 'em and whip, boys.
Loretta Jones.
To be a trader, you need that spark inside. The courage, vision, and determination. The eye to see opportunity, and the wit to seize the right one. IG.
I'm mesmerized. I'm showing off the signs. My mind is spinning out through space and time. Whoa, oh, oh, whoa, oh, oh, whoa, oh, oh, yeah, yeah, yeah. Let's get it together. This could last. This could last forever.
I was actually working at an advertising agency and I thought, what am I doing with my life?
I was lucky enough to get Nikki, and I think that was one of the great joys of my life recently.
If anybody's thinking about becoming a support worker, don't underestimate the difference that you actually make in somebody's life. It's huge.
Yes.
For their full story and rewarding careers, visit Care Careers.
Welcome back to the show. If you've got a question you'd like answered, please pick up the phone, give us a call. The phone number is 1300 30 34 35, and you can also use the email and go for the address yourmoney@skynews.com.au. Alex has called in. Alex is from the Gold Coast. Good evening, Alex. Your question for the panel, please.
Hi there. I love your show.
Thank you.
Two-part question. First part is would like to hear the panel's views on Monadelphous.
Yes.
And the second part is where do you guys see the Australian market finishing at the end of this year?
Okay.
Thank you.
That's great. Thanks for your call, Alex. Monadelphous, a former darling of the market, David Buckland, certainly not now.
So this is the bellwether stock in the service area. It had basically a superb decade, and it's over. So this stock has come back, Alex, as you probably know, from the very high $20 area to, $8.80 or thereabouts. And as I say, it's been the number one player in the space. It had the most marvellous decade, but the last 12 months have just become incredibly problematic. And I would suggest that 2015 and 2016 could end up becoming, very, very, very problematic for this company, because I see a scenario where a lot of its competitors, both listed and unlisted, are going to end up going broke over the next 12 to 18 months. And what will happen is that the rating of this stock will have trouble, being re-rated, even though it's the number one player. So the business side will decrease, and it'll just end up becoming a trading stock. So when oil and iron ore bounce 5 or 10 or 15%, it'll bounce. And when oil and iron ore, etc., falls, it'll fall. But at the end of the day, I see a scenario where a lot of the companies in the sector, both listed and unlisted, will in fact have to call in the administrators over the next 12 to 24 months.
Could that benefit Monadelphous?
Long term, yes, because what will happen is we'll always be mining, and we'll always be trying to get gas out of the ground, and things will come back one day. So they will end up picking up a certain amount of volume one day. But in the short to medium term, I think the prospects just look pretty somewhere between dim and ugly.
Yeah, thanks, David. It does justify their insistence to open up their infrastructure division about 5 years ago, and that keeps some sort of ballast to earnings. But David, no, the numbers looking backwards look sensational. They're not telling the truth, though, are they?
Well, again, it's that sector that they're in, which is just so uncertain. I've got to say, though, there's a pattern on the chart here that I do like.
Yeah, okay.
It's a bullish pattern. So, and there's a bit of volume that's been coming in for the last 3 weeks. So, or last week, in the last week, there's been quite a bit of buying volume. It is on a attractive dividend, very attractive dividend yield, fully franked, as long as the dividend is sustainable.
That's right. Which we won't know till they report, but clearly earnings are under pressure, dividends come down.
Yeah, look, I would treat this as a trading stock for a dividend play. I think for that, it's probably worthwhile play down here.
Yeah.
And it's certainly showing me some bullish, what I call bullish divergences right now on the chart. So that's one thing.
Because from these sorts of levels, if something does look okay, it could jump by a reasonable margin quite quickly.
Yeah.
And I think you both said that, basically, that trading and around factors such as the key commodity prices and the like, and so Monadelphous, not what it was, not that sort of reliable growth in earnings and dividends, but still of interest to the market. So thanks for your call, Alex.
And I think the other question was, where's the ASX going?
Oh, sorry, that was quite true. And did we have a positive answer for that? Do we have a 6 in front of it? 6,000?
This is a, heads or tails question. I mean, it's dominated by the banks and low interest rates and the yield story. Providing nothing goes wrong, and that's a big if nothing goes wrong, then of course, and they keep cutting rates, we'll see the market head up higher, probably to that 6,000 level. But if something goes horribly wrong out there, I can tell you what, it could be at least 15 to 20% lower.
Yeah, it's interesting. Talking about a number like 6,000, people would certainly eyes light up. That's appealing. That sounds great. But it's not much of a return from where we are now. David Buckland.
No, it's only a few hundred points away, and can certainly, another threat of another interest rate cut, it could do that again.
Yeah.
So that's, as we say, it's very much yield driven at the moment, and I think, with the slowing domestic situation and the poor commodity prices and the acknowledgement that the resource super cycle is well and truly behind us, I think there is very high probability it could canter through to 6,000, assuming we don't get a Greece or a Ukraine or a Russia type scenario.
Yeah. Okay. David,
and I was just saying that, like I said, again, it's our level of unemployment is going to be the biggest risk with all the layoffs that I'm reading.
Yeah.
You know, there's nearly $500 billion in interest-only loans against real estate. This is what the Murray inquiry was all about, and this is what Glenn Stevens was worried about. But obviously, they must be concerned because they cut rates, and so it's bizarre. You know, it's bad news equals good news.
Yes.
It's just
it is, and
scenario.
it's always the way like that, isn't it? That's our confounding market. Just I think, Alex, 59.50, but I think you might see it push through 6,000, come back. I think you'll see highs and lows. So we're obviously interested where it finishes the year, but very much interested how it travels through the year as well. So that's very much how we're looking at it. Well, that's all we've got time for on tonight's program. Thanks so much to our excellent two guests tonight, David Novak from Wealthwise Education and David Buckland from the Montgomery Fund. And to you, all our viewers, thanks for your calls, thanks for your emails, thanks for your keeping us on our toes, and hopefully we've been able to give you all the answers you need. Until next time, I'm Jeremy Hook from TMS Capital. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Officeworks has everything for big thinking small businesses. So whatever your big ideas, Officeworks has the lowest prices.
Hotels Combined quickly compares hundreds of hotel booking sites and combines them into one simple search. So finding the best deal is easy. Save on your hotel at Hotels Combined or download our free app today.
You ready for this? Bring it on, muchacho.
Prove who's the better driver once and for all with Amy's Safe Driver app. Challenge your friends and download it for free today.
Read 'em and whip, boys.
Loretta Jones.
What I like about you, you hold me tight. Tell me I'm the only one, wanna come over tonight. Yeah, keep on whispering in my ear. Tell me all the things that I wanna hear, 'cause it's true. That's what I like about you. Just what I like about you.
At SCW Eurodrive, we're all about solutions. From geared motors to heavy industrial gears, simple frequency inverters through to sophisticated decentralised technology or servo controls. SCW can tailor a package to suit your requirements. German technology, Australian know-how, local assembly, sales and service. SCW has the drive to keep you up and running.
SCW Eurodrive.
To be a trader, you need that spark inside. The courage, vision, and determination. The eye to see opportunity, and the wit to seize the right one. IG.
If only everything was as easy as creating your website with Wix. Go to Wix.com today. It's free.
After days of damaging speculation, the government's leadership crisis has come to a head.
This letter has been sent out. They've called for a spill of my position.
As the numbers are being done,
I'm not campaigning.
he has not been undermined. The in-depth analysis from Australia.